So, interpretation of financial statements. Interpretation of financial statements. Financial statements on their own are of limited use. They have limited use on their own. Additional useful information will be gained when the financial statements are interpreted. I've told you on their own they have limited use, but when they are interpreted, then you'll be able to gain additional useful information. So that gives rise to interpretations of financial statements. In this lecture, we are going to discuss how to interpret the financial statements and how to report on them. Make sure you watch the whole lectures from the beginning till the end. So, interpretations of financial statements. So, giving rise to ratio analysis. Ratio analysis. What do you mean by ratios? Ratios shows the comparison or the relationship between one item of the financial statement and the other items within the same financial statement. I've told you that it shows the relationship between one item of the financial statement and the other items of the same financial statements. For our purpose, we are going to group our ratios into one: profitability ratios. Profitability ratio. Profitability ratio. 2, short-term solvency. Solvency and liquidity ratio. Then we have long-term solvency and stability ratio. Then we have investment ratios or shareholders ratios. Then we will as well discuss the operating cycles. Then we have gearing. Then we as well talked about the working capital cycles or operating cycles. So each of these ratios, the computation of ratio depends on the needs of the users. It depends on the needs of the users. Among the users of the financial statement, we have the management. Management will be interested in the profitability level. So meaning that if you have to compute the ratios of interest to management, you compute the profitability ratios. Profitability ratios. Please, you don't just only compute the ratio, but you also need the ability to interpret them. So, in this lecture, I will discuss how to interpret those ratios. And we are going to write a comprehensive report on them, which will serve as a guide to examination questions on financial reporting, or corporate reporting, or strategic business reporting, and case study examinations. Please make sure you watch the entire lectures from the beginning. So, now, I've told you that management will be interested in the profitability level, the ability of the business to generate sufficient profit. So, meaning that management will be interested in profitability ratios. If you have to compute the performance ratio or ratio showing the financial performance, so you are expected to compute the profitability ratios. Then short-term solvency and liquidity ratio. So it is the creditors or short-term loan providers that will be interested in these ratios. The short-term loan providers will be interested in these ratios. So the long-term solvency and stability ratios will be useful to long-term loans providers. The financial institution that gives long-term loans will be interested in long-term solvency and stability ratios. Then the investment ratio, shareholders will be interested in this. Then the gearing will equally be of use to long-term loan providers. It will be of use to long-term loan providers. So I want to start with the profitability ratios. Profitability ratios. Number one ratio that can be used to measure the level of the profitability or the profitability level of an organization is gross profit margin. Gross profit margin. Gross profit margin. This is the ratio of gross profit to revenue. The ratio of gross profit to revenue. That is gross profit margin. When we say margin, we are talking about revenue. Margin means sales. The ratio of gross profit to revenue is said to be the gross profit margin. A single ratio cannot give any useful meaning to an organization. If you have the gross profit margin, if you compute it, if you have 50%, you cannot be able to say if this 50% is adequate. Before it can give you meaning, is maybe you have for other companies who do the same line of business. So industrial average, where you are given industrial average. And if you have industrial average to be 48%, and your own company is having 50%, you will know that your business is doing excellently well. So we also have, now when you compute gross profit margin, there are indices or variables that will enable you to interpret these ratios. Now, number one is your revenue. I want you to know that the higher the numerator, the higher the ratio. And the higher the denominator, if the denominator increases and the numerator is not also increased in line with your denominator, the ratio will fall. There are variables that can make this one to reduce. If this one is higher and this one reduces, the ratio will increase. So there are a number of variables that can make your revenue to increase. Because to interpret your gross profit margin, you have to look at the variable that make up your gross profit margin. Number one is your revenue. So when you buy, when you sell, so your discount, your credit policy will determine your revenue. Then you look into all those ones. Then your gross profit margin, your gross profit, which is your numerator, made up of a number of variables. Number one variable is your cost of sales. And your revenue is part of your gross profit. Your cost of sales is one of the variables. When your cost of sales increases, your gross profit will fall. When cost of sales increases, your gross profit will fall. Then there are a number of variables that equally make up of your cost of sales, which you ought to look into in interpreting your gross profit margin. And those variables include your purchases. Your purchases, where purchases is higher. So your gross profit your cost of sales might be higher, which will go a long way increasing your cost of sales. Your level of inventories, where the closing inventory is higher, that is an indication that your cost of sales will be lower, and that will make your profit to be higher. If an entity is dealing in a slow-moving items of inventory, that means their cost of sales, their closing inventory will be higher, which will go a long way reducing the cost of sales. Where their inventory cannot easily be realized. Realized means to sell. Where their inventory cannot be sold easily, that means the closing inventory will be very high, leading to reduction in cost of sales. So you look into all those variables. That is gross profit margin. The second one is operating profit margin. Operating profit margin or net profit margin. which is the ratio of operating profit. Operating profit. By operating profit, I mean profit before interest and tax. Profit before interest and tax. That's what I mean by the operating profit. Over revenue. Profit before interest and tax over revenue. That is operating profit margin. So, where the numerator is higher, increase in numerator exceeds the increase in revenue, this ratio will increase, and vice versa. So operating profit margin or net profit margin, I said it's operating profit or profit before interest and tax over revenue. We are PBIT, it means profit before interest and tax. Now, in commenting about these ratios, you are going to look at all those reasons you have looked into in terms of gross profit are still applicable to this. In addition to those reasons you have looked into here, then you look at your expenses. Expenses. So where the expenses is high, the operating expenses, where it increases. So expenses ratio, as I was saying. So when expenses increases, the operating profit will reduce. When operating expenses increases, the operating profit will reduce. Then if an expenses increases, in your recommendation, you are expected to tell the management to apply the cost-cutting approach. Cost-cutting approach, that is the use of marginal and assumption or marginal costing techniques. That is your relevant costing concept, that they should apply it in reducing their expenses. Those ones that can be avoided, you look for a way of cutting them down. So, expenses ratio. Then, in order to be able to comment better about this ratio, you can as well compute your expenses ratio as operating expenses ratio or expenses ratio. Expenses ratio equal to the ratio of operating expenses to revenue. This ratio will enable you to know at what rate the operating expenses is increasing compared with the revenue. So you'll be able to ascertain whether the percentage increase in operating expenses is more than revenue. So when it increases, so it can have a bearing on the operating profit margin. Then we also have return on capital employed. This is the primary ratio. Return on capital employed. This is primary. It is the ratio of, it is profit before interest and tax over capital employed. Profit before interest and tax over capital employed times 100, that will give us the return on capital employed. Profit before interest and tax over capital employed. For this ratio, the higher, the better. So, now, in commenting on this, there are two variables that make up of this. Number one is operating profit margin. This return on capital employed is the product of two secondary ratios. We have operating profit margin times assets turnover. It is the product of these two ratios that will give us the return on capital employed. Return on capital employed, ROCE, is the product of these two secondary ratios, operating profit margin and asset turnover. Remember operating profit margin, we said it is operating profit, that is profit before interest and tax, over revenue, times asset turnover is revenue over capital employed. That is asset turnover. If you cancel revenue out, you'll be left with ROS equal to profit before interest and tax over capital employed. That means ROS is the product of these two secondary ratios. To comment on your ROS, your comment must not be one-sided. You have to comment on the operating profit margin. At the same time, you have to comment on the asset turnover. Your comment on operating profit margin is the same with what we have discussed here. Then the asset turnover measures how efficient is the business in the management of their assets. How efficient are they in the management of their assets? Where the management are very efficient, where they are efficient in the management of their assets, then the ROS will increase. And where they are not, then the ROS will decrease. That is return on capital employed. Then we want to consider the short-term solvency and liquidity ratio.